Right now, 10 companies make up about 40% of the entire S&P 500. Goldman Sachs Asset Management puts the number near 40. Back in 2020, those same top 10 were just 22%. And three stocks, Nvidia, Microsoft, and Apple, are roughly 20% of the index all by themselves. So here's the uncomfortable question. You own an index fund. Maybe you own 5 funds. You feel diversified. But are you actually spreading your risk? Or are you making one giant bet on 7 companies and just calling it diversification? If you've ever had a quiet, nagging feeling that you don't fully understand what you own, you're not wrong, and it's not your fault. The way these funds are built actively hides it, and it's easy to feel lost. Stick with me, because here's the fix, and you can run it tonight in 10 minutes. Let me give you the answer up front, because this video isn't a mystery. Diversification has almost nothing to do with how many funds you own, or even how many stocks you own. It's about how many independent bets you own, positions that don't all rise and fall together. You can hold 500 stocks and still own basically one bet, if those stocks all move as a pack. The fix is a single habit called look-through. You open your funds, you look at what's actually inside them, and you add up how much of your money sits in the same handful of names. That's it. The rest of this video is why that habit matters and exactly how to do it. So how did a simple index fund quietly turn into a concentrated bet? The mechanism is cap weighting. Almost every index fund weights its holdings by market value, which means the biggest companies automatically get the biggest slice. That sounds fair, and it is, but here's the side effect. When a handful of giants outrun everything else, they don't just win, they take over the index. The top 10 went from 22% of the S&P in 2020 to nearly 40% today. The Magnificent Seven, Nvidia, Apple, Amazon, Microsoft, Alphabet, Meta, Tesla, are about 33% combined. And it's not just stock concentration, it's sector concentration. The information technology sector alone is now about 35% of the S&P 500, the highest since the dot-com bubble. Here's the part that should stop you. At the peak of the dot-com mania in 2000, the top 10 companies were about 27% of the index. Today, the top 10 are pushing 40, and the top 20 are 49%, half the index in 20 names. By that measure, today's market is more concentrated than the dot-com peak everyone points to as a warning. You didn't choose that. The math chose it for you while you held the same fund. Now here's where people fool themselves the most, and you might be doing it right now. Owning more funds feels like more diversification. It usually isn't. Picture the classic diversified portfolio, an S&P 500 fund, a total U.S. market fund, a NASDAQ fund, maybe a tech fund you liked. Sounds like 4 bets. Look inside, and it's 1 bet wearing 4 costumes. The S&P 500 is about 80% of the total U.S. market by value. So an S&P fund and a total market fund are almost the same fund. The NASDAQ 100 and the S&P 500 overlap about 35% by weight. If 5 different funds all have Apple, Microsoft, and Nvidia sitting at the top, you don't own 5 bets. You own 1 bet, 5 times, and you're paying 5 expense ratios for the privilege of buying the same stocks again and again. Even the safe stuff sneaks it back in. Plenty of target date funds and so-called international sleeves quietly re-import the same U.S. megacaps. The number of tickers on your screen is not the number of bets in your portfolio. This is the idea that ties it all together, and it's the one most people never get told. What actually protects you in a downturn is not the count of your holdings. It's the correlation between them. Correlation is just a measure of whether things move together. 500 stocks that all sink at once in a tech sell-off behave, for your account balance, like a single stock. They give you the feeling of safety without the substance. Real diversification needs assets that march to different drums, value versus growth, companies outside the U.S., smaller companies, bonds, real assets. The test isn't do I own a lot of things. The test is when one thing falls, does something else hold up? If the honest answer is no, they all fall together, then all those holdings were 1 bet the whole time. Think of it like structural engineering. 10 support beams made of the same brittle material aren't redundancy. They all crack in the same earthquake. Redundancy means different materials failing under different loads. So what do you actually do? 3 concrete moves. First, the look-through, and you can do this tonight in about 10 minutes. Pull up each fund you own, find its top 10 holdings. Every provider lists them, and add up how much of your total money lands on the same 5 to 10 names. If that number is 30 or 40%, you're not wrong to own it. But now you know it's a concentrated megacap bet, and you chose it on purpose. Second, if you want to dial the concentration down, look at how the index is weighted. An equal weight S&P fund gives every company the same slice instead of letting the giants dominate. The effect is dramatic. Technology drops from about 35% of the fund to roughly 13%, and boring sectors like industrials and financials move up to the front. There are even equal sector funds that give all 11 sectors the same weight. These aren't magic. They're just a different rule for who gets the money. Third, notice the built-in discipline. According to S&P Dow Jones indices, an equal weight index automatically rebalances. It trims the winners that have grown too big and tops up the laggards. That's a structural buy low, sell high mechanism that a cap-weighted fund literally cannot do, because cap weighting is designed to let winners run. One more data point that shows the strain. The cap-weighted S&P now trades at a price-to-earnings ratio around 28, about a 28% premium over its equal weight twin. Historically, those two traded at nearly the same valuation. That gap is the concentration, showing up as risk you're paying full price for. Now let me argue the other side honestly, because this cuts both ways. That same concentration is exactly why the index has crushed almost every active manager for a decade. The top 20 names drove about 64% of the S&P's 5-year return. If you'd equal weighted through that run, you'd have left real money on the table, paid a bit more in fees, and underperformed for years while the giants led. Diversification is not free. It has a cost. And in a mega-cap bull market, that cost is performance. So the takeaway is not equal weight always wins, or sell your index fund. Plenty of smart investors look at these numbers and happily keep the concentrated bet. The point is narrower and harder to argue with. Know what you actually own, and size the bet on purpose instead of by accident. So here's the one thing to remember. Count independent bets, not funds. The number of tickers you hold tells you almost nothing. The overlap between them tells you everything. Do the 10-minute look-through, add up your exposure to the same top names, and decide, deliberately, whether a 40% bet on a handful of giants is the bet you meant to make. Diversification isn't a number of funds. It's a number of different outcomes you're prepared for. That's tonight's working theory. If it was useful, there's a new one here every night at 7. And I'm genuinely curious. Run the look-through tonight and tell me, what percentage of your money is sitting in your top 5 names? Drop the number in the comments. No judgment. I just want to see the spread. This is educational, not financial advice. Your situation is yours. See you tomorrow night at 7.